Peter Rose, Longwood Currency Trading. Why trade Forex currencies? And I say Forex currencies because some of you may not be familiar with the market. It's sufficient to say Forex because it means foreign currency exchange. But too often the currency part of it is missed. Why trade currencies? And there are three reasons, and I think you probably should be very much aware of those instead of just jumping into a market because your buddy says that there's something to do, or you see somebody on a video proclaiming how much money he made trading currencies. The currency market, the Forex market, is a real market. And it has three characteristics that you need to look for really in anything that you get involved in from an investment or trading standpoint. It has to have a purpose, it has to have liquidity, and it has to have availability. Now, there's a lot of stuff out there. You know, I would discount the stock market and all the exchange traded markets for that matter, simply from an availability standpoint, because they're only open from anywhere 7:30 to 9:30, somewhere in the morning, until the close of business at 5 o'clock, where the currency market is open 24/5. But we're just talking about currencies now to show that they have those three primary characteristics of purpose, liquidity, and availability. If you don't see this as any of these characteristics as a critical factor in your ability to learn a skill that can provide you a job replacement income, then you shouldn't get involved in it. You should be fearful of it. Knowing these three things will give you confidence to spend the time to learn how to trade these markets, because the payback from them can be relatively infinite. Purpose, liquidity, and availability. Okay, purpose. What's the purpose of the Forex market? It's not to entertain you. The Forex market in 2022, this is late November of 2022, is $6.6 trillion a day. That dwarfs all the other stock markets combined on a daily basis. When I started looking at these markets in 2007, it was $3 trillion, and now it's $6.6 trillion a day. Why? What does it do? What's its purpose that it would generate that much money? It deals with international commerce. If someone in the Eurozone wants to buy something in the United States, they have to pay dollars for it. So they have to sell the euro and buy dollars. They're selling euros and buying dollars. That's the exchange. So you have Euro-USD currency pair. So that folks that live under the euro financial system can trade with somebody that's using a US dollar. Because if somebody came to me to buy my car and they wanted to pay me in French francs or something, I couldn't do it. I wouldn't do it. What am I going to do with French francs? I can't do it in the United States. So you'd have to come to me with dollars. Correspondingly, if I wanted to come over there to France and buy a car, they're not going to take USD. They're going to want French francs. I'm going to have to make a conversion. So that's the purpose of the market. And you go, well, yeah, so what? Well, so what is that if we were just talking about a couple of cities exchanging between them, and I've got Chicago, Illinois currency trading with Alabama currency, or maybe Paris, France currency, that would be problematic because you could have a huge snowstorm that would shut Chicago down, and the currency market would come to a screeching halt. What we're talking about is countries, the United States and the Euro, the Swiss economy making trades with maybe Turkey. These are entire nations, entire economic nations they're like cruise ships. You don't just turn them on a dime. The cruise ship starts out to go from point A to point B, not to zigzag their way through. They're on the way there, and it's difficult to change that direction. And so you see probably more favorable long-term trends in currencies than you would in penny stocks or maybe just general stocks, in fact. Quarter four results for a stock come out and people don't like it, stock goes south. In currencies, it's an entire economy. So you could have a major manufacturer go broke, and so the people that were doing the trading with that manufacturer would suffer, of course, but from the standpoint of the currency, the Swiss currency and the German currency, is that going to affect that exchange rate? Probably not, unless the collapse of that company was going to affect the entire economy, and then it would take time, just like it takes time to turn a ship. So the purpose of the Forex market is not for us as retail traders. The purpose is so that countries can do exchange, economic exchange between them, and that's a critical factor of the strength and the purpose of the Forex market. It's not based on trust or hope or fear or greed or anything else. Maybe the retail traders, those of us that are in the retail trade part of it, which are only 80 or 85% or 15% of the markets, 85% or 80%, 90% of the institutional traders that are running this thing. The 15% of the market was back when in the early days, my early days in the currency markets, 2007, 2012, somewhere in there, where the market was $3 or $4 trillion a day, and the retail market was 15% of that. I don't know what it is now at $6.6 trillion. It's probably not 15%. The basis of the Forex market is on something solid. It's as valid as when the U.S. dollar was gold backed. It was based on something. So the currency market is based on the economies of the two different countries that are trading. Now, if the country gets into economic despair, then people are going to start saying, well, this isn't looking too good, and the market will turn around. But as bad as that currency would get, they still have to buy stuff from another country. They have to buy food products or manufacturing products, or they're doing services exchange. Maybe attorneys are working to purchase a house for a foreigner coming in. You're going to have that currency exchange. So even though the economies are changing in their viability, perhaps, the currency market is still there. So it has a purpose. It's based on a purpose. So that's purpose. The second factor is liquidity. The third is availability. Liquidity means how much activity is going on. Well, that's $6.6 trillion a day, dwarfing all the other investment vehicles that are out there, all the other stock markets combined in the United States, the New York Stock Exchange, the American Exchange, all of that stuff. It's just that's just shit dust in comparison to $6.6 trillion a day. And so that means if you're trading the six major pairs, that's where the 90% of the liquidity of the currency market rests. If you're trading cross pairs or exotic pairs, Thailand and Tibet or something, you could probably get a pair across on that. But the amount of economic exchange is nowhere near as great as a euro or a pound or something like that. So that would mean that those off major pairs might not have that liquidity. And why would you need liquidity? Well, look, When you want to get out of a position, you want to be sure that there's somebody there to either buy, sell, to get you out. And liquidity means that they'll get you out. When you see gaps in the stock market, and particularly gaps in the futures market, commodities markets, the gaps get so big that they shut the exchange down. There are no gaps per se in the currency market because there's so much liquidity. You can always find a buyer, you can always find a seller, always in quotes, because there are times when that liquidity just simply may not be there. Maybe it's in the middle of the night for both countries and nobody's trading, and some big guy comes in and decides he's going to dump his position, and it's a thin market at that time because nobody's awake, and you may get a tremendous precipitous movement in the price. The guy doesn't really satisfy his needs. He picks up the retail trader's stops. Banks don't put stops, so you're only scooping the retail market. So if you have an enormous load to take, you're going to have to run that thing way down, and you're just not going to. If the liquidity isn't there, it's going to eat that stuff up, and it's going to come right back to where it was. You're not really too concerned about that. You may look at the charts on some of this stuff at non-farm payroll, for example, and you see these huge candles spiking. Oh man, I wouldn't want to get caught in that. Well, you don't trade the non-farm payroll. I mean, that's just retail traders going berserk, trying to guess which side to land on. And that's not anything to do with the market. That's more to do with how the trader chooses to put their bets on the table. Okay, but the liquidity is there. Very rarely are you going to have a problem with liquidity. And the third characteristic is availability. How long is that market open on a daily basis? All markets, even the real estate market, is generally only open during regular business hours, 9 to 5, right? Well, what happens if I want to buy my house at 8 o'clock at night? Oh, you can sign the contract, but you're not going to be able to get to the bank and make that transaction happen. You're not going to be able to sell that stock. All of a sudden you learn that you have a medical emergency and you're going to need $10,000. You're not going to be able to sell that Tesla stock or that Microsoft stock or GM. You're not going to be able to sell that until the market opens. And if there's enough panic out there when the market opens, it all goes to hell, and there's gaps, and you lose instead of win. So the availability of the currency market is it's open 5 days a week, 24 hours a day. It's open from, here in the United States, Eastern Time. It opens 5 o'clock on Sunday, 5 o'clock p.m. on Sunday evening, and it closes at 5 p.m. on Friday evening. So you get that 5 days. Depending on your time zone, that's going to change when it happens. When you're looking at the currency market, it's a global market, and so from the East Coast United States to Australia, it might be 12-hour difference, and so generally things are based on GMT. So you can go to the different countries and see what time their currency market opens on a Friday. It might not be 5 o'clock. That's just when the U.S. opens, but somewhere there it's going to be different. Everywhere it's going to be different. The availability in being open 24 hours a day for 5 days is enormous. If you want to trade currencies, if you're working a job from 6 in the morning until 8 o'clock at night, and you want to trade at 2 o'clock in the morning, because that's when you have to get up to go to work, you can trade at 2 o'clock in the morning in your PJs. You can trade at 3 o'clock in the morning, 5 o'clock in the morning. Noontime. They don't go out to lunch at noontime. There's somebody at that desk, and it's not noontime, and there's trading going on. And so the availability is unmatched in any other market. And because of the liquidity, you can always trade and always be sure at any time of the day or night. Now, of course, the liquidity sort of reduces itself during off hours when the two countries are maybe not as active with each other. But maybe the let's say the Australian dollar might not be very active in trading in Thailand at a certain time, or you pick two places that are really far apart. They may not be as active, and so therefore, because of that liquidity, the availability is there. Liquidity may be a little thin, and you'll see that your spreads between the bid ask begin to increase. I mean, you could see that in pound dollar, for example, which I trade quite a bit. And on a Friday, as markets are getting ready to close, the spread will go to 14 pips when it would normally run 1.2 or 1.5 pips or something like that. And so the availability has to be combined with the liquidity, and it's all those are supported by the purpose of the market itself. If you're looking for something to trade where you have the least exposure to risk, the currency market is it. The Forex market is it. Now, you could say, oh, I talk to all these people and they lose all this money. Yeah, they lose all their money because they don't know what they're doing. I lost $50,000 because I didn't know what I was doing. I listened to all these people on the YouTube videos and all driving around the Lambos. Very entertaining, but not very enlightening as far as education. And you try to read a book, and it's like trying to learn a foreign language by reading a dictionary. It's very, very difficult, and takes a little bit of time to learn the skill. You're not going to learn to be an auto mechanic in 5 days, and you're certainly not going to learn to trade currencies in 5 days. There are more productive ways to go about learning than others, but you have to be bright enough to be able to differentiate the different resources that are available to you as to which one you feel most comfortable in learning these skills. And you have to have some kind of a broad-based idea of the market and what the purpose of that market is and what the function of you as a trader within that market is, in order to and then balance that with the liquidity and the availability, and see if the market itself fits your needs as a trader. When you're going to be available to trade, is there always going to be somebody on the other side of the table to take your trade? Is there a real reason behind the trade taking place in the first place? Or is it just like crypto at this particular time, which is not based on anything concrete except, I could buy a car with it if the car dealer will take crypto in exchange for it. But who would? Because of the volatility of the market. The car dealer would only take it if he thought that the token was going to go up. It's not based on anything. Crypto is not based on a car or gold or the goodwill of the government or anything. It's based on somebody's willingness to buy it from you at a higher price. That's all it is. So you have to base your decision as to what you want to trade and take your money, your $3,000 or your $300,000 or whatever it's going to be that you're going to be trading, and you have to base the risk of that against the market that you're trading. Do you want to take that money and go into the casino and, well, you shouldn't be doing that anyway, but and putting it on the roulette wheel where it's 36-1 against you? Or do you want to go pass line craps where it's 1.41% or something against you? It's still against you 1.41%, but it's not against you that as much as on the roulette wheel. So if you're going to go in the casino, play something with that has the odds. Or play 21. If you're going to go into the investment world, if you want to do long-term investing, you don't want to come into the currency market to do that. This is not appropriate for that. It's a trader. It's a trading market. You don't want to hold positions for weeks or months at a time. The currency market over a week's period of time could go 400 pips. If you're trading at 30 bucks a pip, that's 12,000 bucks. Do you have that kind of resource that you're going to want to hold? I've been through swings like that, just gyrations in the market, and I every time that happens, I go, why did I put myself in this position? I can make $1,000 a day relatively easy on average, but that's because if I take a large size of my bank and trade it, but to make $200 or $300, $400 a day, that's relatively simple with a reasonably sized bank. And at the end of the day, you're out. So you either make it or break it within the course of the day. You only hear the stories of people that are losing, and the fact that 90% of the currency traders lose their money in 90 days because they don't know how to trade. They take somebody's stupid $500 course to learn what a pip is and how to size their bank, and this is a Bollinger Band, and this is how you trade the Bollinger Band, and here's an engulfing cattle pattern, and you're all set. You're not all set. You're going to lose your money because that's not trading. That has nothing to do with trading. If you know how to trade, you'll make money. If you know how to drive your car, you'll be able to get to the grocery store to buy your groceries and get home safely. If you really know how to drive that car, you can win stock car race. If you really know what you're doing in currencies, you can replace your job income. And the reason you can do that in the simplest manner and the safest manner in the currency market is because of its purpose, its liquidity, and its availability. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.